I made over $200 in dividends, and the math says I can increase this to at least $300 and even get it up to $800 a month with no new money in the portfolio. On average, more than doubling the payouts from just a simple switch in the holdings. The even crazier thing is that the part of this portfolio that pays a dividend is only worth about $20,000 total, but I only moved around $5,000 worth. So the dividends before the changes were already high compared to some of the traditional dividend investments we've heard of. Now they're projected to be even higher. Dividends traditionally are low-yield investments that slowly compound over time. So with this massive increase in dividends comes higher risk. That's the trade-off. So now the question is, why the change? Well, last Monday I got home from work and I'm thinking, I'll rest my eyes for 20 minutes. I wake up and it's completely dark because 4 hours had passed by. Now the only thing I have time for is to go back to bed. You'd think that because I just slept for so long, it would be hard to go to sleep again. Wrong. Lights out as soon as my head hit the pillow. I was exhausted. The next thing I know, my alarm is ringing and it's back to the office I go. You've probably had a day or even a few days like this too. We are constantly managing limited resources, time and energy. Notice I didn't say money because they've been printing more every year since before you and I were even born. There's plenty of it out there. So much that some stranger ended up making a better version of money called Bitcoin. When we capture some of this money from a job, side hustle, birthday present from grandma, where we put it can help us get back more of our limited resources. We just have to figure out where the opportunities are, what the risks are, and how to manage that risk. If there's an opportunity to earn more with less, I'm interested, and if the risk is worth it, I'm taking it. A year and a half ago, I started investing with the intention of making money without doing anything, completely independent from my time and effort. I wanted to build a golden piggy bank that I put money into and magically it would start making me more money. His name is Earl. Hi, I'm Raj. On this channel, we talk about money, and in this video, my money. We've spoken a lot about dividends, ETFs, crypto, and current events, but opinions and data are one thing. Real live positions are valuable. In this video, I'm going to open up my Robinhood portfolio, show you the dividends for June 2025 for all the positions, but also show you what I sold and where that money is now. Obviously, this isn't financial advice. Don't go blindly copying me. That's a great way to lose money. So consider this financial show and tell so you can see how I'm thinking about what makes up the portfolio. I first bought JEPI in April 2023, and those 30 shares in June 2025 paid me $16.14. For JEPQ, the 23 shares paid me $14.34. For SPYI, I was paid $12.58. For FEPI, the dividend was $24.78. SVOL paid me $13.83. ULTY paid me $13.45. NVDY paid me $22.79. MSTY paid me $36.82. YMAG paid me $22.94. XDTE paid me $10.36. And finally, for SCHD, the dividend was $101.32. Of course, SCHD pays quarterly, so that averages to $33.77 for June 2025. In total, the portfolio paid me $221.89 for the month. The total value of the ETFs that paid those dividends was roughly $19,500, give or take, because the markets fluctuate. So that means in 1 month, my yield was about 1.13%. So that was the high-level performance of the funds. Let's deep dive into the positions and get to the changes I made that simplified the portfolio and massively increased the projected monthly dividend. First up, my largest holding in this account is SCHD. This is what I'm considering the core position of this dividend account. It's nice and passive and honestly super boring. It's so boring that even articles that criticize the fund don't really raise too many eyebrows. It actually just sparks conversation rather than controversy because the fund just is what it is. SCHD has a selection criteria for stocks like dividend payment history, size of the company, and other fundamentals, and through this strategy, it's able to pay a dividend every quarter. Based on that selection criteria, it will move stocks in and out of the fund and rebalance on its own. It's not flashy or absurdly high risk, and historically has been a good bet for a long-term dividend investor, offering a growing dividend year over year and capital appreciation, meaning the fund has gone up in value over time. Sure, there's other strategies like individual dividend stock picking and even other dividend-focused funds entirely, but for me, this is a nice, easy place to put my money because it does the work for me. It requires zero time and effort. I don't have to research any stocks. I just get a dividend every 3 months and have zero stress about it. I kind of forget I even own it most of the time, so that's kind of exactly how I want it. With that being said, it's not perfect. It has three main issues. Dividend investors might want a more frequent payout, and other investments exist that pay monthly and even weekly. Higher yield paying options exist, and SCHD has no exposure to real estate and basically no exposure to tech stocks, which typically don't pay dividends or otherwise fit the inclusion criteria for the fund. So how do we address these three issues? Well, we buy more funds. Enter JEPI and JEPQ. Both of these funds pay monthly dividends, so they solve problem number 1 for SCHD. They offer a higher yield than SCHD, so problem number 2 is solved as well. And because JEPI is concentrated on the S&P 500 and JEPQ is based off the NASDAQ 100, exposure to real estate and tech is covered. Here's the catch. They're covered call ETFs. They don't just buy and hold stocks and pay investors dividends. They are actively managed. So a fund will use options trades and give us the premiums. There are other ETFs that use a similar strategy, but generally they all do the same thing. The problem is that one of our biggest expenses is taxes, and that's no different in this portfolio since this is a taxable account. SCHD, by and large, is considered a tax-friendly dividend-paying ETF since its distributions are largely considered qualified. But from JEPI and JEPQ, this friendly tax treatment is out the window because the money we get paid in a taxable account from them would be considered ordinary income, and that is taxed at a higher rate. So this is where SPYI comes in. It's a covered call ETF like JEPI, but instead of using single stocks in the S&P 500, it trades on SPX options. This just means that SPYI is more tax efficient, even though the strategy is a tiny bit different than JEPI. Now, FEPI is one of the more interesting covered call ETFs in this portfolio because it concentrates its focus on FANG stocks. And so far, this has produced higher yields than most funds in this portfolio. SVOL is an ETF that produces a yield from something called the VIX, so it doesn't use stock options to generate a yield. I see this as an income investment, but it's part of a diversification of income play. ULTY is a fund from YieldMax that allows them to trade options on volatile stocks without strict rules of what and how to buy and sell. So this allows the fund to trade on our behalf, which is perfect for me since I see this as a hedge against myself, since I'm not very good at trading options. It's like investing in a hedge fund without all the contracts and huge capital requirements. If they do well, I win. If the professionals can't make money, then I certainly had no chance either. NVDY and MSTY are also from YieldMax, and they use a synthetic covered call strategy to generate high yields from NVIDIA and MicroStrategy. And YieldMax has other funds that do the same thing, and YMAG is the combination of some of those funds that are part of the MAG 7. Finally, XDTE uses a 0-day to expiry option strategy based on the S&P 500 with the intention of generating a yield for investors. So still options based, but just a different strategy. So each has its own advantages and disadvantages. What's on the chopping block and why? First is SBOL. Long story short, I'm down on the position, and even though it did survive a volatility spike, I can't justify holding onto it simply because of opportunity cost. I could put this money somewhere else that is able to get a higher yield that could potentially grow in value as well. This ETF has value to a specific type of investor. It's just not me at this time. Next, XDTE, for how much money I have in the fund, it does seem to work to generate a weekly yield, but month to month, the yield isn't as high as other funds in this portfolio. And long term, I don't know how this will hold up as the market dynamics shift, so it's worth keeping an eye on, but it is time for me to sell. Next up is FEPI, YMAG, NVDY, and SPYI. That's a lot, I know, but I don't think the market will continue to stay concentrated in top stocks. When interest rates come down, or if the market suspects interest rates will come down, I believe riskier assets will benefit more than top stocks that already went up in value. I think a rotation to smaller cap stocks and riskier assets like crypto will happen. So something like YMAG and FEPI that focus on a handful of stocks I'm not confident will hold up in the short term. And because I think NVIDIA has been a large beneficiary of AI and will be what people rotate away from, I'm selling NVDY. So what about SPYI? Well, it does have tax advantages, but to be honest, this portfolio isn't big enough to justify investing for tax advantages. And long-term, SCHD is likely going to be the biggest payer of all the dividends in this account. At this moment in time, in my opinion, it's better to take calculated risks to try and grow this account and worry about tax efficiency later. So where is the money? Close to $5,000 from the positions I'm selling going. I'm buying more MSTY because MSTY is effectively a Bitcoin play, and I believe that Bitcoin still has some room to run up and make a new all-time high. While I wait for that to happen, I can earn a yield in the meantime. MSTY has been on an impressive run and distributions are insanely high. So based off recent payouts, I can expect at least $1.23 per share, since that's the lowest dividend it's ever paid. And since I bought a few hundred shares, the math works out to a total dividend payout for the portfolio at about $300. Now here's the kicker. MSTY has paid as high as $4 per share multiple times in its history. And if it does it again, that would put the monthly dividends over $800. The monthly dividend for MSTY has had extreme volatility, but on average, it paid out $2.47 per share, which translates to over $600 a month in dividends from just the MSTY shares alone, which is a 3x of my original dividend. With that being said, this portfolio is now much more risky, nothing is guaranteed, and I will be heavily on guard. I will also be selling when I think it's the right time, because when Bitcoin eventually tops and enters into a bear market, MicroStrategy and MSTY will go down as well. On the other hand, because I'm still bullish on Bitcoin and crypto in the short to medium term, but still want to build dividend positions for the long term, I think this portfolio more accurately reflects that belief. If you're interested in how I'm going to determine when it's time to sell MSTY because a fourth of my position is on the line, there is data out there that can help. And if you give me 6 minutes, you'll know exactly when to buy and sell crypto and MSTY from this video on your screen or in the description down below. Thanks for watching, and I'll see you over there.